Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for that common sense approach to planning, guidance with your money, your investments, your financial and retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire here with us, as always, providing much needed information. And Chris, looking out at the year ahead, everything I'm hearing is that we could be in store for another kind of challenging, difficult year financially and economically. What are you hearing or what are you seeing as kind of your best guess forecast?
Yeah, I would say, there are certain economic headwinds, that all of the interest rate raises that they have done previously, that economic, whatever you want to call it, damage or carnage is going to play itself out. And, that's globally, not just here in the United States. We're not the only central banking system raising interest rates. We've got the geopolitical pieces going on. We've got China threatening to invade Taiwan, ramping up that rhetoric, and Kosovo and Serbia, are very close. Serbia has their military on full alert. And, that's going to lead, that's a volatility, and the markets do not like volatility typically.
No, absolutely. A lot of forces in addition to what we see here in our economy, inflation and interest rates. And Chris, one thing that we are all paying attention to, I guess we may be on the front edge of this conversation, but we should be paying more attention to it regardless year around. But it is coming up on tax season here. We will probably start to see those forms coming in the mail to compile and file and prepare the returns. But what we want to talk about is maybe a more proactive kind of stance and approach to taxes and the possibility of building more tax-free retirements. So I like the idea of that. And I know that you are a self-proclaimed tax geek that puts a lot of work in with your clients on a daily and regular basis to help them have the best tax situation possible.
Yeah, I do enjoy, helping clients navigate the tax situation, which, sometimes can be complex. We did a fair amount of tax planning here in 2022, or at the end of 2022, I should say, with regard to, non-IRA assets, and then, harvesting some of the losses that people would have had over the course of that investment year, helping people convert IRAs to Roth IRAs, and what dollar amounts do we do that in to be the most tax efficient. And, when the market goes down, and takes a pretty good hit, 20, 25, 30%, that's a good time to start moving money into a Roth IRA and then let it recover on that side, because you're paying less in tax. Hopefully you're buying toward the bottom and letting it recover on the tax-free side. That's a good win-win right there. And, people need to realize that, look, when bad things are happening, that means you need to be proactive for those of you that can. And we like to help a lot of our clients with that. And Mike Peter says, I guess I'm kind of a tax geek. My buddies would call me another kind of geek, but I'll take a tax geek.
Well, opportunities for proactive planners to be more efficient, which means we get to keep more of our money and to better control and minimize our tax bill, I think are things that most of us are looking for. And ladies and gentlemen, if that's something that you would like to have a conversation on and maybe identify these specific strategies that could be advantageous for you, pick up the phone and give Chris McIntire and McIntire Retirement Services a call. 800-868-1194. That is 800-868-1194. 800-868-1194. There's pretty much a universal consensus that taxes stink, Chris, but there's also a perception that there are some tax strategies that only the wealthy utilize, or tax secrets of the wealthy. Are there any exclusive tax caveats that only the ultra mega rich can use, or are these same tax opportunities available for all of us?
Well, I don't think, we don't get involved in offshore banking or anything along those lines to kind of go to the extreme there with a smile on our faces. That's not anything that we get involved in. But, a couple of the unique pieces would be, the cash value inside life insurance has can have special tax features and benefits for policy owners. And, it's a strategy I do use for myself in full disclosure, where you can effectively borrow against your policy income tax free. So, you've got, just say you got $100,000 of cash value in your life insurance policy. You can structure a loan out of that where the insurance company gives you a loan and uses the cash value inside your policy as the collateral for that loan. They charge you a fair amount of interest. And the idea is you have the ability to make more money than what they're charging you in interest on borrowed money, right? So if we can make 5% and pay out 3%, that's a 2% positive arbitrage on money you borrowed from somebody else. So, and that's a tax-free piece as well. So yeah, we do like that concept where it fits in the right places. That's a unique one there.
Chris, I recently heard kind of a conversation and setting the tax component of this to the side for a moment. I heard that regular people buy things using debt. Smart people buy things using cash, but the wealthy generally buy things utilizing appreciating assets as leverage. And then, the conversation was about major kind of purchases and investments. But what you're talking about with this component of borrowing money and then utilizing that is that concept. We've got an appreciating asset that we're leveraging and utilizing to build wealth at the same time as creating cash flow.
Yeah, exactly. It's a good way to not, to put that in place for the listeners out there, Peter. Well done. And, does it fit for everybody? Of course not. We use them in, the way we set up our policies is pretty, not of the normal. We want to get it funded in a 5 to a 7 year time frame. In most cases, depending on the age, 10 years is typically at the outside. Again, and control the cost of the policy itself so that we're being as efficient as we possibly can, the way we've structured the policy, right? Because fees and expenses matter. The other side is, well, God, I don't need but what if I don't need any life insurance? All right, well, how about some tax benefits and then let the person that gets the death benefit, income tax free, decide what they want to do with it. So, it's a good win-win, right? You can structure it for yourself, income tax free if done the right way. And then if you pass away, that death benefit goes out income tax free as well. That's a good win-win. Name me a mutual fund that'll do that.
Yeah, and a good estate and legacy planning tool as well. So this is just one of the conversations about creating and planning for a tax-free retirement. One of the opportunities to utilize to achieve that goal or to be tax efficient. But there are many, many other strategies and options. We'll dig into a few of those as the program goes on. But a reminder, ladies and gentlemen, if this is a conversation that has been overlooked, if you have not had specific conversations about managing and controlling and minimizing and eliminating taxes, then you owe it to yourself to have that conversation and to explore what options are available. Chris McIntire can have those conversations with you in the complimentary review and the game plan for retirement design and strategy session. Give a call, 800-868-1194. That's 800-868-1194. Chris, is this, in your opinion, a conversation that too often gets overlooked?
Yeah, I think it's because, most people think, the tax conversation, well, there's nothing I can do about it. I'm just going to put money in my 401k and I'll deal with it down the road. That's kind of human nature. Especially when you're talking about using a life insurance policy as a tax benefit vehicle of some sort for yourselves. That's not what most people think of life insurance, but that doesn't mean it's wrong, right? Just means not everybody does it. You have to monitor and make sure the policies are performing as they need to. It's not a set it and forget it strategy. Nothing is. If you're going to get into a Roth conversion strategy, that's typically not something you're going to do 1 year only. You're probably going to look and do that over the course of several years. And again, the younger you are, the longer you have to do some of that tax planning. So, the sooner you start, typically the better that's going to be for yourselves. And remember, anybody can take money from an IRA and put it into a Roth IRA. There are no age restrictions. There aren't any penalties for doing that before 59 and a half, because it's going from an IRA into another IRA. One just happens to be a Roth. So that's allowable.
So again, opportunities to better control your ultimate tax liability, your lifetime tax bill. And you need to identify which ones are right for you. Chris McIntire can help. He can quantify that move, what it's going to cost, what the potential likely benefit is if you don't do it or you do enact a Roth conversion strategy, and the time frame that you should do that over to help control and minimize that ultimate bill. All part of the game plan for retirement, the written retirement income plan that Chris puts together for his clients. And regardless of where you are in your process and progress, he can help you to achieve those financial goals through the plan. So pick up the phone and give a call, 800-868-1194, 800-868-1194. Chris, for really more than a generation now, we have been taught to do exactly what you mentioned, which is sort of kick the can down the road, put money in the 401k, and defer and delay the tax bill as long as possible. Is it time to rethink that paradigm and maybe make a shift?
Yeah, especially the younger you are out there, because tax rates are a lot lower than what they were when your parents were working, if you will, going back into the...
You take the highway, fastest way from point A to point B, or are you kind of taking the scenic route kind of guy, Chris?
I like to get there as quick as I can, then I take my time. So, yep, I don't want to, I'm not, maybe when I retire and I have more times to do the Route 66, I'll be good with that, but not necessarily, not there yet, buddy.
All right. Well, tax preparation, Chris, has kind of a meaning in our mind, but tax planning may have a different definition and meaning. A lot of us, in fact, all of us around or before April 15th do the tax preparation, but maybe not enough of us are doing proactive tax planning. Can you talk about what each of those mean and what the fundamental difference is?
Yeah. So, if you do all of your tax preparation and whatnot in the month of April, the week before you go see your CPA, that's not tax planning. Tax planning is something that's going on throughout the course of the year. And it may start with your accountant saying, hey, you should put $7,000 into an IRA, or you can put $7,000 into a Roth IRA. And, you can do that for the prior year. So, so in April of 2023, you can still do some tax planning for 2022, but in 2023, you want to be able to look, you want to do tax planning and say, look, if my income is this dollar amount through the month of October, I can pull out another $20,000 out of my IRA, as an example, and convert it into a Roth and still be in the same tax bracket. Maybe the 12% brackets where we do a lot of that planning, where if you pulled out $50,000, maybe 30,000 of that's going to be in the 22% bracket. And maybe you do that in the next year then to maintain in that 12% bracket. As an example of tax planning versus, all right, I'm going to do all my tax planning the week I go see my accountant in April and we're in an emergency, and that's not tax planning typically.
And once again, Chris, you're helping to schedule that and quantify that, and then trying to talk about the expense of enacting those strategies, because it is a pay me now or pay me later system at the core of retirement and tax planning. That is the fundamental understanding that we need to have. And you can really put a dollar value in comparing that pay me now or pay me later.
Certainly, yeah. I mean, just remember the IRS changed the rules and said, okay, for people that passed away, I think it was, 2020 and on, you've got to withdraw an inherited IRA that you got from somebody else, not your spouse, your parents, grandparents, that kind of thing, brothers or sisters, you got to drain that account within 10 years now, and you have to take a required minimum distribution out. So, they set a set of rules with that, said, okay, at the end of 10 years, the account's got to be emptied, and you can wait until the 10th year to take it all out. Okay. Now they said, okay, yep, you still have to do that, but every year you still got to take a little piece out. So they changed the rules and then added another caveat to it where, if you were going to get that money into a Roth IRA, yep, somebody's going to inherit that Roth IRA, but they're not going to pay any income tax on it when they have to distribute it out. And that's a lot more tax planning when there isn't any income tax involved, when there is income tax involved, because if you're the beneficiary, okay, and grandma and grandpa don't want to take anything extra out because they don't want to get in the 22% bracket, but you're in the 37% bracket, so you kind of got to think, what's my legacy here? Why am I really doing this? And, understand that situation, and everybody's is different, no doubt. If you're going to leave all that money to charity, then you don't need to worry about the taxes. If it's a qualified charity, they're not going to pay taxes when they get the IRA anyhow.
Yeah, and we definitely want to talk about a few of those specific strategies, such as a charitable deduction. A qualified charitable deduction, QCD, is a fantastic opportunity that we will talk about, that you can create truly tax-free money. One of the few in our lifetimes where we've got that opportunity. But Chris, in your assessment here, looking at these opportunities, it really sounds like you believe that Roth IRAs, Roth 401ks, this is probably a pretty advantageous opportunity, or at least a strong consideration that we should be looking at and examining.
Oh, yeah, no question about it. And, and on an individual basis. So depending where you're at, where your income is certainly something you want to take advantage of. The younger you are, the more time you have to plan for these things. When you hit 72, or what is going to be now 73 years old with the new Secure Act 2.0, we'll probably do a show specific to that here in early January, February 23. And speaking about, the new changes that were just enacted as part of a $1.7 trillion budget, we won't go into that today. But, understanding, where do we fall in all this? Should we take advantage of it? And, look, I can run scenarios on what makes more sense, a Roth conversion or cash value inside life insurance policies. And I can tell you which one typically is going to beat the other one. And most of these folks listening today wouldn't believe me, but the cash value inside life insurance policies certainly has a lot of, good aspects about it. One being, you could make it a safe strategy where you don't have any market losses. Okay, you could have it where it's got a nice tax-free income distribution, and manage it that way as well. You could cover your long-term care expenses. A number of different avenues that your typical 401k, Roth IRA, mutual fund portfolio will not do for you.
And once again, if you are not having these conversations, you may be missing a very important aspect of making the most and the best use out of your opportunities. So pick up the phone and give a call, have a conversation with Chris McIntire. No cost, no obligation to ask a few questions over the phone, or even come in for the complimentary review, the investment and retirement account analysis, and the game plan for retirement design. You just need to call and take advantage of this opportunity, the true value of this program. 800-868-1194. That's 800-868-1194. 800-868-1194, the number to call. There are a couple other opportunities, Chris, with having some tax advantaged accounts or even tax-free dollars. One of them, the HSA, Healthcare Savings Account. Are you a big believer, proponent in an HSA?
Yeah, no question about it, buddy, because, we have a high deductible plan. My wife and I, we're not on Medicare, so we certainly max out our health savings account. We get to deduct the contributions into it. We can invest the money within our health savings account in mutual funds, that type of thing, or just leave it in a savings account. Ours has some flexibility. It has an investment component to it as well. And then if we use it for qualified, there's that term again, qualified medical expenses, that money that we take out of it is income tax free as well. So, it's kind of like a Roth IRA, but you get to deduct your contributions for healthcare expenses. That's a big win-win. That's the first thing I want to get funded and get out of the way if we have extra dollars to start the year off, is get that HSA funded completely, because you never know what can happen.
Yep. Once again, talking with Chris McIntire about ways to be more efficient with our dollars, to control, minimize, even eliminate some unnecessary taxes, creating a tax-free retirement to be the ultimate goal. And you do have strategies and opportunities available to you, ladies and gentlemen, and to identify which ones are right for your specific situation. Have a conversation with an experienced, qualified professional with a tax planning perspective. And Chris McIntire is here as that resource. If you would like to have that conversation, pick up the phone, give a call, 800-868-1194. That's 800-868-1194. Chris, a few other specific strategies that I do want to hit on before the end of the program, but circling back to something that you've mentioned several times, the Secure Act. It basically solidified a couple things in my mind. One, that the government, that the IRS and that the Congress can change the rules on our retirement accounts anytime they want. And two, with the passage of the Secure Act and now the Secure Act 2.0, they really solidified the fact that IRAs are for retirement, but they are not wealth transfer, legacy, or generational tools. In fact, they may be one of the worst kind of accounts for leaving money generationally to family and loved ones.
Yeah, no question about it. Why would you want to, if you're thinking about it rhetorically like that, Peter, why would you want to leave a tax bomb for your beneficiaries when you could leave them tax-free money? And, that would be the Roth IRAs, the life insurance death benefit as well. And so there are many, many ways to, kind of tear apart some of these strategies that made a lot of sense a long time ago, but do they make sense in today's world like they did previously? We're not discounting, that you shouldn't put money into your 401k. Most of you certainly should, because it's an easy, disciplined approach. They take it out of your paycheck. You never miss it. That's why you pay taxes that way, because they know nobody would pay taxes if you actually had to write the check to the Internal Revenue Service. What am I paying for?
Yeah. And indeed. But Chris, with the now more commonly available Roth 401k option, I think there's a lot of misunderstanding and misconception. There is a commonly held belief that if we choose to save money on the Roth side of the 401k, that the company no longer matches. Can you discuss that point for a moment and clarify that misunderstanding for us?
Yeah, and the company certainly still does match that 401k, Roth 401k contribution. Now, as part of the Secure Act 2.0, they were talking about the ability for the companies to put that match in the Roth 401k. And I got to be honest with you, Peter, it just passed so recently. I don't know if that piece went into it or not. But before, if you were going to opt for the Roth 401k, and the company was going to match, they would match into the traditional 401k because they could not put in the after-tax dollars. And there was talk on that. Forgive me, I forgot if they got it done or not.
We'll check that out. But in general, companies nice enough to offer the match, not generally nice enough to pay your taxes for you, but they still will match even if you opt to pay the taxes up front.
Absolutely. And that's an important piece. Getting that match, and it's free money taken from somebody that's been self-employed basically their whole adult life. If they're going to offer you free money, you're probably going to want to take that, guys.
Absolutely. All right. So more strategies for controlling taxes, and this one for a specific purpose. Chris, if we are saving for the specific goal of helping fund college education for our children or grandchildren, there are some potential tax advantages with the 529 account. Are you a proponent of utilizing that for college expenses?
It's probably my least favorite way of doing it. Because, if you go in and fill out a financial aid form, that's the first thing that you have to put down on there is, all right, what do you have in a 529 plan? What can we kick you off of? Kind of like. So, they don't ask about the money inside your cash value life insurance policy, which you could borrow income tax free and pay for college expenses as well. Or if you didn't go to college, you can do whatever you want. A little more freedom.
I know there's a little bit more flexibility with dollars outside of the 529. So we may want to look at that on a case-by-case individual basis. Another advantage, Chris, is the tax exemption on profit on our personal residence. And I think that there is some misunderstanding about that, but that is a big opportunity for the majority of Americans to have some dollars tax-free during their lifetime.
Sure. Yeah. And for most folks here in Northwest Ohio, we don't have to worry about any capital gains on our primary residence. We just don't make those kinds of profits here in Northwest Ohio. We're not Gulf Shore Boulevard and, West Palm Beach or Naples, Florida, for example. And, so, a lot of people think, hey, if I sell my house, what's my capital gains going to be? Well, it's your primary residence. And, in all likelihood, there's not going to be any capital gains taxes, even if you made $150,000, $200,000 on it.
Well, again, we're talking about ways, strategies, opportunities to better control taxes and maybe create that tax-free retirement, the ideal situation. There are strategies available to do just that, ladies and gentlemen, and you need to identify those all along the way in your financial process and planning, and then execute and enact where those opportunities would be beneficial to you. Chris McIntire can help you identify them and show you the best way to enact those strategies. It is part of the game plan for retirement planning process. Pick up the phone if you would like to take advantage of a conversation, a complimentary review, a planning strategy session, and to get your written game plan for retirement put together. 800-868-1194. That's 800-868-1194. 800-868-1194. Now, Chris, this year, I know that there's a lot of talk of the market being volatile like it was last year, and tax loss harvesting is going on. Capital gains going to be a conversation in our non-qualified, non-retirement investments. And this, again, is an area that you help people look at so that we are controlling and paying the least amount of tax possible.
Yeah, no question about it. It's not what you make, guys. It's what you get to keep. And, being a proficient and efficient and smart about how you do your tax planning is a key element, because you can make 30% in the market this year, but if your income taxes are exorbitantly high just because of the way you did things, was it all worth it?
Now, Chris, we did mention charitable donations. The qualified charitable deduction, QCD, is a big opportunity for truly tax-free dollars over our lifetime. Can you break that one down for us?
Sure. A qualified charitable distribution deduction simply means if you are at above the age of 70 and a half. So this goes by the old rule, 70 and a half, and you can take up to $100,000 out of your IRA and pay it directly to a charity. And the charity would get that, income tax free, and it would not be come on your taxes, and it would satisfy your required minimum distribution as well. So pretty big win-win. Again, it's got to be a qualified charitable. You'll hear Peter and I say that word qualified on different respects. That just means it meets all of the all the rules. I said qualified medical expenses for HSAs,
qualified educational expenses for 529s, qualified charitable distributions for those QCDs. But you meet those qualifications, and there are opportunities for truly tax-free dollars, ladies and gentlemen. And there is some amount of order of operations to be as efficient as possible. That's what Chris McIntire helps to lay out for his clients each and every day. And it's something that a lot of investors say they are looking for and missing as part of the conversation in their planning. So it's not what you make, it's what you get to keep. It's not what you have, it's what you get to keep and spend out of that. And taxes are going to be one of those things that make a big difference. Proactive tax planning for these tax expenses proactively and identifying the right strategies can make a big difference. That's why Chris McIntire is here to help. Pick up the phone, give a call. This conversation, planning, identifying these strategies is part of the game plan for retirement, the written plan and the planning process that Chris McIntire will go through with you and help put together for you. 800-868-1194, the number to call. That's 800-868-1194. Chris, always a pleasure getting the opportunity to speak with you. Man, I saw some recent waves from Lake Erie that were just scary. I don't know about taking a boat out there as often as you do, buddy.
Well, I tell you, that was a heck of a storm we had here at the later part of over the Christmas weekend, basically, and kind of once in a lifetime stuff. I feel bad. A lot of the animals got frozen in the ice. It was unbelievable.
Well, we appreciate the time, Chris, and I know that into this year ahead, a lot of people are going to be looking at these proactive tax planning strategies, and you're here to help and be that resource. Thank you for being such a resource for us.
Yep, my pleasure, and let's hope we have a happy 2023, folks, and make it better than 2022 for sure.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.